The consumer staples sector rising about 7% since the start of August. That outpaces the S&P 500. This ahead of this week's expected Fed rate cuts. Here to discuss what's ahead for the sector, we want to bring in Arun Sundaram. He is a CFRA Research Senior Equity Research Analyst. It's great to have you, Arun. So talk to us about some of the outperformance that we have seen in consumer staples. There is a notion out there, a thought out there, not necessarily too unique, just about the fact that maybe we have come a bit too far when it comes to the valuation of some of these consumer staples stocks. What do you think?
Sure. Yeah. Thanks for having me. Yeah. I think, the consumer staples sector has done pretty well over the last month or 2 months or so. Defensive sectors in general have done pretty well over the last 2 months. We are in a seasonal, slower period. Defensive sectors tend to do better in September. But we as a firm at CFRA, we are still underweight consumer staples. With the Fed likely to cut rates this week, we think cyclical sectors are best poised for long-term growth. So we're currently overweight sectors like information technology, communication services, and financials, and we are currently underweight consumer staples, energy, materials, and utilities.
Arun, what does that tell us about your thesis and your firm's thesis on the broader strength of this economy? Because typically I think of consumer staples as somewhat defensive, whether you've got people shopping at Walmart just because they're always going to, or God forbid we head into a recession, it's also going to stay clean. So what does that tell us about your broader view of where this economy is heading?
Yeah, there's a lot of I think there's some concern on the economy, the concern that the consumer spending environment is slowing. We're certainly seeing that as well, especially pockets of consumer spending. The lower income consumer is struggling a bit more right now, and I think that's why we do see we do believe that they're going to be winners and losers, whether it's a discretionary sector, consumer discretionary sector, or the consumer staples sector. We do love the big box retailers right now in the consumer staples sector: Walmart, Target, Costco, BJ's. These are the retailers that are, we think, gaining market share. They have strong e-commerce platforms. E-commerce is an area that's growing really attractively right now. And these retailers are all really pride themselves on convenience and value, and that's where consumers are heading right now. So it's these big box retailers that we think are best positioned, and that's why we are even though we're underweight consumer staples, we do have a positive fundamental outlook on the consumer staples merchandise retail sub-industry, and that includes Walmart, Target, and BJ's and Costco.
Yeah, Arun, I want to stick on that because I noticed the PE ratios for Walmart and Costco in particular are pretty elevated compared to some of the rest of the retail sector. To what extent is that a concern for you, or would you say that maybe even is part of some seasonal defensiveness that's driving up the stock price of these names?
Sure. No, certainly the PE ratios of a lot of these big box retailers have expanded, especially Walmart and Costco. But we believe that this expansion is warranted. Especially considering the margin trajectory of some of these retailers. For example, Walmart. Walmart's operating margins have somewhat been stable for the last decade or so, but we're just starting to see pretty strong margin expansion at Walmart. And one of the biggest reasons why is Walmart is expanding beyond its core retail business. It's getting into higher margin service streams like advertising. It's fulfilling orders for third-party suppliers. It's doing financial services. So it's really, the business models for a lot of these big box retailers are evolving, and I think that bodes well for margins. And I think that's one of the reasons why we're seeing PE multiple expansion for these big box retailers.
Arun, what happens, and you briefly touched on this before when we talk about recessionary concerns, but even those types of retailers, how big do they at all see a hit if we do see a recession, or are they then viewed as such defensive plays, and because of the trade down or trade in, however you want to call it, they're actually able to weather any sort of downturn much better and without any notice compared to some of their other competitors?
Sure. Yeah. Certainly, during periods of slower economic growth, it's these big box retailers that tend to do well. They tend to see a trade down from consumer shopping there. That bodes well for them. I think another big thing is that consumers right now are eating out less. They're starting even. Last year was really the slowdown in this full service restaurant channel, but now we're seeing that broadening of a slowdown throughout the food service channel, and so more consumers are cooking, eating at home. I think that bodes well for retailers like Walmart. We recently also upgraded Kroger to a buy from a hold, and I think that'll bode well for them as well. But really, I think, one of the reasons that we're really positive, not just over the next year, but over the next 3 to 5 years, is really this what I was talking about before, about how these retailers are expanding beyond retail and getting into the higher margin revenue streams like advertising. A lot more advertisers are now advertising on websites like Walmart.com, for example, and that's really, I think, positive for the long-term margin trajectory of these retailers.
All right, Arun, we're going to have to leave it there. Thank you so much for joining us. Really appreciate it. That's Arun Sundaram with CFRA. Thank you.